Donald Trump's renewed tariffs are creating tremors across the global landscape.
When one superpower builds walls, others start building bridges. While the White House is busy imposing trade restrictions, Beijing and New Delhi are signing billion-dollar contracts not with Washington, but with Ottawa. Not long ago, this would have seemed impossible: China, India, and Canada as allies. But now these agreements are redrawing the map of global trade.
And America's aggressive trade posture is pushing allies and partners to seek alternatives.
It all started with one decision. When Donald Trump's administration introduced tough trade tariffs under the slogan "America First," it hoped to strengthen the domestic market. But the effect was the opposite. Companies began to relocate production, global supply chains collapsed, and allies began to look for new partners. Today, economists are sounding the alarm. The US is losing up to $1 trillion a day in potential revenue, while the largest Asian economies are making deals behind its back.
Second, to reinforce the competitiveness of Canadian businesses. And thirdly, to build the strongest economy in the G7.
Canada, at first glance a neutral player on the periphery of geopolitics, has unexpectedly come to the fore. Skillfully seizing the moment, Ottawa offered China and India what they had long been looking for: access to key resources, stable legislation, and most importantly, no political pressure. The contracts signed are already estimated to be worth tens of billions of dollars, and this is only the beginning.
And to these ends, the United States has announced a series of trade actions. Those began near the start of this year with the so-called IEEPA tariffs against Canada and Mexico based on U.S. concerns about the border and fentanyl trafficking.
But what does this have to do with the US? It's simple. Previously, American companies controlled the main export routes for Canadian resources. Now these contracts are going to Asia. According to independent analysts, each week of this capital outflow costs the US economy hundreds of billions in lost profits. And these are not just numbers on paper, they are lost jobs, missed investments, and a weakening of the dollar's influence. Meanwhile, Beijing and New Delhi are moving quickly. They are investing not only in trade, but also in infrastructure, logistics hubs on the Pacific coast, railway projects, joint technology parks. Canada, with its direct access to both oceans and political independence from the US, is becoming an ideal platform for new Asian influence.
As a result of these developments, the breadth and the depth of the changes in U.S. trade policy have become more fully apparent.
Against the backdrop of these events, Donald Trump continues to promote the rhetoric of harsh economic isolation. But in today's world, where the speed of a transaction is more important than the flag on a container, this could cost the United States more than ever. We are witnessing a tectonic shift. Western economic alliances are cracking at the seams, and new ones are forming without Washington's participation. And this is just the tip of the iceberg. What exactly did Canada, China, and India sign? Which industries have already begun to restructure? Why does big business in the United States no longer see the White House as an ally? And most importantly, will America be able to regain its lost position, or has the global economy already gone down a different path?
Those trade deals with other countries also have limited or no relief from those sectoral tariffs in those strategic industries such as steel and autos. They include substantial commitments by the U.S. trade partners for investments in the United States and significant unilateral trade liberalization measures by U.S. trade partners.
Stay with us, it's only going to get tougher. Today we'll tell you what the official reports are silent about and what the evening news ignores. Are you ready to find out who is really winning in the new economic game? The global economy increasingly resembles a chess game, where one careless move can cost you the entire game. And while the US was once considered a confident grandmaster in this game, recent years have called its strategic advantage into question. When Donald Trump's administration launched a full-scale trade campaign against China, imposing unprecedented tariffs and tearing up international agreements, it hoped to boost domestic production and redistribute profits in favor of the American economy. In practice, however, a chain reaction began, the consequences of which are becoming increasingly apparent today, not only in the form of a slowdown in American exports, but also in the form of a reformatting of global trade relations in which the US is losing its position. Since 2018, the tariffs imposed by Trump on Chinese goods have become a symbol of the trade war, which in theory was supposed to balance the trade deficit. However, the figures tell a different story. By 2020, the value of imports from China to the US had fallen by 25%, but domestic consumer prices had risen by an average 12% in key sectors, from electronics to construction materials. At the same time, American agricultural producers began to lose the Chinese market, which previously brought them up to 20% of their export revenue. Asian powers, primarily China and India, began to look for new partners willing to supply raw materials and technology without political conditions.
As in previous trade disputes, Canada has implemented a series of retaliatory tariffs. Their objectives have been to protect Canadian workers and businesses and to incentivize a negotiated settlement with the United States. Few other countries followed suit.
It was against this backdrop that Canada unexpectedly emerged from the shadows. Its participation in the trading system had previously been perceived more as an add-on to the American market. Most of Canada's exports traditionally went to the US. But after breaking a number of agreements with Washington, Ottawa began an active reorientation. China and India instantly saw an opportunity in this: stable democracy, rich natural resources, a favorable geographical position, plus Canada's position outside the rigid military political alliances of recent years. All this made Canada an ideal candidate for a new strategic partnership. Behind the scenes of the trade negotiations in Vancouver, in May 2025 lie deals that have already been called the turning point of the decade. The Chinese side signed a framework agreement worth more than $180 billion for the supply of rare earth metals, timber, and agricultural products. India, in turn, invested more than $75 billion in the development of logistics infrastructure in Western Canada and gained direct access to Canadian ports for large-scale imports of energy resources. These figures were hardly covered by official channels, but a document leak in a Toronto business publication confirms the key parameters.
Throughout our negotiations with the United States on a new trade and security relationship,
The reasons for this shift are profound. First, Asian economies are seeking to break their dependence on volatile US policy decisions. After Congress blocked the extension of tariff exemptions on high-tech equipment in 2023, more than 60 Indian and Chinese companies began searching for alternative sources of supply and product assembly. Canada, with its moderate tax policy and access to raw materials, found itself in the spotlight. Second, Trump, who returned to big politics and intensified his rhetoric against globalization, made it clear that no one would give cooperation a second chance. Protectionism in Washington became not a tactical measure, but an ideology. While American companies are struggling with the consequences of Chinization and the breakdown of logistics chains, Canada is increasing its presence in Asian markets. Trade between Canada and India grew by 38% in the first 6 months of 2025. China increased its purchases of Canadian liquefied natural gas by 70% compared to the same period last year. Even taking into account inflation and energy price fluctuations, HSBC experts call this an unprecedented economic reset.
the United States has also imposed substantial trade actions on the Canadian lumber industry. Now, in recent weeks, the United States has agreed a series of trade deals with a variety of countries. And these deals have several aspects in common. First, baseline tariffs that cover a broad range of goods and services that are substantially higher than those U.S. tariffs that existed before.
The irony is that America itself pushed its main trading partners into each other's arms. The bet on coercion through tariffs did not result in the return of factories to Detroit for the US, but in capital flight, a decline in external demand, and geopolitical isolation. Moreover, many American corporations, unwilling to lose their positions, have begun to register subsidiaries in Canada in order to participate in new trade schemes now under the Canadian flag. Economists at MIT recently conducted a study in which they modeled the potential losses to the US if current trade barriers remain in place. According to their calculations, if the trend continues, by the end of 2026, the US economy will lose about $2.4 trillion in potential GDP. This amount is made up of lost exports, increased production costs, the replacement of American goods with Asian equivalents, and a decline in global confidence in the dollar as a universal unit of account. Meanwhile, strategic optimism reigns in Beijing and New Delhi. Despite their own differences, these two countries know how to act in unison when it comes to the struggle for economic influence. They are building their partnership with Canada, not only on the principles of mutual benefit, but also on the expectation of long-term stability. Contracts are signed for 10 to 15 years with the possibility of automatic renewal. Joint investment funds, educational programs, and cultural exchanges are being created, all of which strengthen trust and give businesses more freedom.
Those were quickly followed by reciprocal tariffs on every U.S. trade partner and very high sectoral tariffs applied globally on strategic industries, including steel, aluminum, autos, and copper.
The US is currently observing this process from the outside, hoping to recoup its investments through internal reforms. But if the Canada-Asia alliance strengthens, the United States risks finding itself in a position where even its traditional allies, Japan, South Korea, Germany, will prefer to work through more flexible and less politicized schemes. And then the consequences of protectionism will be irreversible. This turn of events is not just an economic trend. It is a sign of a shift in the balance of power. While some are closing themselves off, others are uniting. And while some are building walls, others are signing contracts that will shape the economy of the next decade. If there is a language in the global economy that everyone understands, it is the language of contracts. And while the US continues to speak the language of sanctions, tariffs, and trade barriers, China, India, and Canada communicate through agreements, deals, and infrastructure alliances. These are not just pieces of paper signed for show, but transformational documents that lay the foundation for decades to come. The details of some contracts have not yet been fully disclosed, but leaks and indirect data allow us to reconstruct the overall picture, and it leaves no doubt the US is losing not just economic positions, but entire spheres of influence.
In a positive and very important development earlier this month, just a few weeks ago, the United States reaffirmed a core commitment to our free trade agreement, CUSMA, by reinforcing that those Canadian exports to the United States that are compliant with that agreement, that are compliant with CUSMA, will not be subject to U.S. IEEPA tariffs.
The negotiations held in Canada in the spring of 2025 resulted not only in record sums, but also in surprisingly tough conditions from Beijing and New Delhi, which the Canadian side accepted with virtually no objections. Unlike the American practice, where agreements are accompanied by endless legal reservations and unilateral exit mechanisms, these agreements were drawn up on the principle of strategic non-interference. Neither party can restrict the technological or financial sovereignty of the other. Roughly speaking, if a Chinese company gains access to a Canadian lithium mine, it is not required to report to any third-party entity, including American auditing bodies, to which it previously had partial access through corporate schemes. The contracts cover 6 key areas: energy, rare earth metals, agriculture, high technology, logistics, and education. In the energy sector, India has acquired a stake in the largest liquefied natural gas terminal on Canada's west coast. According to unconfirmed reports, this deal includes a clause on priority pricing for the next 20 years at a fixed rate that is already 18% below market value. This means that the Indian economy will now receive cheap gas, bypassing traditional suppliers, including the US. China, for its part, has signed an agreement to develop several uranium and graphite deposits, with the possibility of processing directly in Canada and, importantly, without the obligation to sell part of the volume to the North American market.
In fact, the average U.S. tariff rate on the world has jumped from just over 2% at the end of last year to almost 16%, 8 times higher. 16% currently.
Agriculture has become an unexpectedly acute element of the agreements. India has signed an exclusive contract for the supply of Canadian wheat, barley, and rapeseed, with a volume of up to 18 million tons per year. In return, it will invest in agricultural infrastructure, including the construction of elevators and processing plants. But the most interesting thing is that China has initiated a project to buy out the intellectual property rights to seed technologies previously developed with the participation of American companies. In fact, through Canada, China is gaining access to agricultural developments that were previously blocked by sanctions. Technology is another layer. Chinese investors have established a technology park in the suburbs of Calgary, where several startups previously registered in Silicon Valley have already relocated. Rumor has it that Canadian regulators have simplified visa and tax conditions to such an extent that the cost of doing business in this technology park is now half that in California. Moreover, there is a mechanism for state funding of developments in the field of AI and microelectronics if Canadian or Indian researchers are involved. This means that instead of a brain drain to the US, knowledge and innovation are now beginning to concentrate in a new tripartite center, Canada, China, India.
Specifically, under the new U.S. approach, countries must now buy access to the world's largest economy through a combination of tariffs, investments, unilateral trade liberalization, and policy changes in their home markets.
Logistics is worth mentioning separately. China is investing in the construction of a second railway line from Vancouver to Montreal, intended exclusively for cargo bound for ports for export to Asia. At the same time, India is participating in the construction of a logistics hub in eastern Canada, intended for the re-export of goods to Europe. As a result, Canada is becoming a transcontinental bridge, taking over the functions previously performed by the ports of Los Angeles and New York. It is estimated that by 2027, freight traffic between Canada and Asia will increase by 400%, and the US will lose at least 18% of its transit revenue. All these processes could not go unnoticed in Washington. The US Department of Commerce has released a confidential analytical report, part of which has been leaked to the press, stating that as a result of the new agreements, American companies will lose up to $3 billion a day in lost contracts and increased logistics costs alone. If we add to this the increase in the cost of imported goods and the loss of jobs in ports, the total daily economic losses could reach $1 trillion in terms of cumulative GDP over a 10-year horizon. This calculation method is debatable, but the point remains the US is losing ground in strategic sectors, and if it were just business, the consequences would be predictable. But the problem is that the loss of economic influence is starting to turn into a loss of political clout. Already today, within the WTO and G20, Canada is increasingly voting in unison with Asian powers, demonstrating a departure from the pro-American line. Moreover, a number of countries in Latin America and Africa have begun to show interest in similar contracts with Canada, bypassing the US as an intermediary. This means the emergence of a new trade axis in which America is no longer the center, but the periphery.
This new U.S. trade policy has several motivations: to raise tariff revenues, to protect strategic industries, to encourage foreign investment in the United States, and to change trade and non-trade policy in U.S. partners.
Of course, in the short term, the US retains enormous resources, influence over international financial institutions, and technological infrastructure. But even the biggest players lose their advantage if they don't adapt in time. And now it is not just corporate profits that are at stake, but the very structure of the global economy. In a world where China and India are creating alternative centers of gravity, and Canada is becoming an economic portal between East and West, the US risks being left with a set of ideological slogans but no real leverage. Ultimately, the question is no longer whether other countries will sign similar agreements, but how long it will take for the new trade architecture to completely replace the old one. And by all accounts, this process is already underway. While the world watches the geopolitical cards being reshuffled, Canada is quietly transforming itself from the quiet neighbor of the US into an independent global player. What seemed unlikely 10 years ago, Canada's trade and economic leadership within new alliances, is now becoming a reality. The reason is not only Ottawa's well-calibrated policy, but also the vacuum that formed after the United States began to close itself off from the world under the pretext of protecting its domestic market. In this vacuum, Canada found itself the only developed country with access to key natural resources, a high level of investor confidence, and a geographical location that allows it to trade effectively with both the East and the West.
Our negotiations with the United States have been taking place as the U.S. has been in the process of fundamentally transforming all of its trading relationships.
The world media are already calling Canada the new trade hub of the 21st century. Direct transport corridors to Europe, the US and Asia, access to the Atlantic and Pacific Oceans, political neutrality, a strong legal system, liberal migration policies, and free access to capital have all combined to turn the country into a logistics and investment magnet. And while it used to play a secondary role in major deals, it is now the gateway for initiatives that are changing the economic landscape.